Namaskar, dear friends. The result season is almost over. I had covered my portfolio stocks and a few other important stocks. Lot of stocks are there still to be covered. I think I will cover them in December. In the meantime, I thought many of you will need to recollect the types of analysis that we need to do to become successful investors. See, all of us want to become successful as investors. Some people are very, very successful. I am also moderately successful, but I have been rather lazy in investing to the best of my ability. My ability is great. I have no doubt about that. As some of you must be knowing from my profile, I have passed a number of exams conducted by the National Stock Exchange, and based on that, NSE has given me a certificate. NSE Certified Market Professional Level 5, which is their highest certification. I think I should have taken another certificate from SEBI, but I didn't do that. Same subject, still a little less only compared to NSE. Now, we will go through some of the fundamental concepts in 2-3 installments, 2-3 videos. As you know, if you want to be a good, successful investor, you must know a few things: fundamental analysis, technical analysis. For long-term investors, fundamental analysis is crucial. For day traders or traders, technical analysis is a must. For day traders or short-term traders, fundamental analysis is not of much concern. Whereas for long-term investors, medium-term investors also, technical analysis is not very important, but fundamental analysis is very, very important. I want to be only a medium or long-term investor. So I focus on fundamental analysis. Fundamental analysis of a company's prospects covers the overall economy of the country, industry scenario. There may be a number of companies in an industry, and then the past, present and future of the particular company for which you are doing the fundamental analysis. Fundamental analysis focuses on finding out the intrinsic value of a company's shares. I am not going to debentures, bonds, etc. Only shares. Maybe after 3 months or 6 months, I may cover trading also, because some very revolutionary changes are happening there. Now, for the intrinsic value, what is that intrinsic value? You see, we know the company's shares actual market value, market price at any time, not the intrinsic value of the share. Intrinsic value means what is it really worth. It may be going for 100 rupees in the market, but its real worth may be 200. Over a long period of time, not very long, market price will get adjusted to the intrinsic value. So today if you find the intrinsic value of a company, then you need to compare with the market price and find out whether the intrinsic worth is much more or much less. If it is much more, it is worth buying. It is much less. If you are having, you sell, but don't buy further. So that is why the intrinsic value is very, very important. Based on the intrinsic value and the current market price, we try to estimate its future prospects by finding out whether it is undervalued or overvalued compared to the market price. So, to repeat, what are we trying to find out in fundamental analysis? The fair intrinsic value of the company, not the price. We assume that someday, maybe in the near future, the intrinsic value will move up to be the market price. What you are today finding it out as intrinsic value will become the market price after some time. But on that date, the intrinsic value also might have again changed for the better or for the worse. So, if it is undervalued, you buy. If it is overvalued, you sell. Now, I can say technical analysis does not think about this intrinsic value or anything. It watches the price trends and does price analysis and volume analysis. So it will try to predict by evening what will be the share price, by tomorrow what will be the share price, within 2 or 3 days what will be the share price. Based on that, short-term investors will try to buy or sell today and repeat the opposite action after some time. We are not concerned with that sort of short-term market operations. So in the fundamental analysis, we try to find out the overall trend of the economy. Of course, India is growing. Even when the whole world is going down, India was going up for various reasons. One of the things is proper managing of the economy by the government and the RBI and also the companies. Then, so overall economy, then overall specific industry. See, an industry may have 10 companies, 20 companies, even 100 companies. So, what is the scope for that industry to go further, to expand further, to improve its value further? So, from overall economy to the industry, if these two things are good, in your opinion, then comes the financial performance of the company. So, where do you get the information for all these things? Financial analysis is again, there is a qualitative analysis, there is a quantitative analysis. Qualitative analysis focuses on the company's management. What is their reputation in the market? The brand value of the products, how much the investors like the products. So these are the qualitative analysis. Also some other factors like corporate governance are there. Corporate governance means how the company is being managed by the management. Are they honest to their investors? Are they honest to their customers? Are they honest to the government, like company law board, SEBI, and so on? So corporate governance standards are also there. Now, corporate governance standards are many a time stated specifically in their annual reports, etc., in their websites, annual reports, etc., and you will have to watch whether those standards are being adhered to. Sometimes you find some companies are not adhering to corporate governance standards set by themselves or set by company law board, set by a act. Now it may come in newspapers, it may come in government reports, then you have to be wary about that company. So then come to quantitative analysis. Quantitative analysis is done with reference to annual reports, quarterly reports. Annual reports will be balance sheet, income statement or profit and loss statement, and cash flow analysis. In the balance sheet, you find what is the amount of debt, what portion of the profits have been taken to the reserves, and so on. Many factors are there. Balance sheet analysis is a wonderful subject. Then, in income statement or profit and loss statement for usually an year. There you will find expenses and incomes. Balance sheet you find assets and liabilities. In income statement or profit and loss statement you find incomes and expenses, and the balance is either profit or loss. You will need to invest only in profitable companies. Don't go to invest in loss-making companies unless their near future prospects are very, very good. Sometimes we do that also. Now, what are the other factors we take into account? Financial data that we have just now told. You will have to see acquisitions, selling of a division, acquiring a division from other companies, acquiring companies, acquiring brands, acquiring products. This also is there. Then expansion programs. See, what we have just said, acquisition, that is also expansion. External expansion programs. Internally also expansions are continuously going on in most of the companies. That is what ensures the progress of future profitability. Now, in for our purpose, quarterly statement is something like profit and loss account of a quarter. So there you will find the same thing, incomes and expenses. The balance is profit or loss. As I said, you will go for a profitable company only. Now, people have to calculate certain ratios also based on this balance sheet, profit and loss account, and quarterly statements. Like profit margin, return on equity, future growth prospects, what is the sales to other expenses ratios, which is the major expenditure, how it is progressing over a period of time, etc. Normally, I take into account 5 quarters quarterly statements. There I especially watch, that is fundamental analysis principle only, I especially watch progress of sales from the previous quarters to the current quarter. If all the 5 quarters sales have been increasing, that's a heartening sign. Likewise, net profit should be going up from quarter to quarter to quarter, like that all the 5 quarters. Is that enough? No. You will have to see what contributed to this profit. Sometimes, an exceptional loss or an exceptional profit due to sale of some asset, etc., may be there, which may have contributed to the profit. So, those exceptional losses, exceptional profits must be removed, and then you will have to find out whether the profits have been really increasing on a regular basis. Now, there everybody sets his own standards. As far as I am concerned, generally I feel sales should be increasing by about 20% year on year and maybe about 10% quarter on quarter. So 20% year on year, about 10% quarter on quarter. But some companies are increasing their sales by more than 100%. So wonderful companies, you will have to identify such companies. I do identify. Then net profits, they also must be increasing by more than the sales. In other words, percentage wise, sales might have increased by 20%, profits must increase by more than 30%, 40%. I try to find out companies which have increased their profits much more than 100%. There are such companies. There are companies which have increased their profits by 80%, 70%, 50%, very good. So companies which have increased their profits by just 5% year on year, meaningless. Companies which have incurred net minus, that is negative growth, don't touch them. So these are some of the factors which determine my assessment of the companies and my purchases. If a company fails me in these factors for more than 2 quarters, I try to find out a different company. Not that this company will not come out, but some other company may be progressing much better than this company, therefore I try to find out a different company. So, some shuffling is always there. So, quantitative analysis, qualitative analysis, management reputation, brand value, products value. So, these are all qualitative. Quantitative are sales growth, profits growth, and many ratios are there. So debt equity ratio also is a very important ratio. Price earning ratio is a very, very, very important ratio. Price to book ratio is also a very, very important ratio. Now, if you calculate all these things, or if ready-made calculations are available for many ratios in many famous, reputable websites, dependable websites, then this company may be good by itself. But if there are 10 companies in the industry and if the other companies are better than this company, where will you go? You compare those companies with this company and the price advantage also. And then you make an analysis whether this company is okay or the other companies are okay. When comparing also, you need to take into account the respective expansion programs. See, the expansion programs are a very important consideration for a buy decision. Then one of the other factors is market share. What is the market share of this company's products vis-a-vis other companies in the industry? Their market share. So all these factors need to be taken into account while judging a company. Then the another important, very important factor is cash flow analysis. Profits may be 100 crores, but what is the cash which came out of those profits? In some companies, cash flow is more than the profits. In some companies, cash flow is much less than the profits. So, which one will you go for? Obviously, cash flows, why cash flows are very important. You see, accounting is a very tricky subject. You can manipulate the profits by increasing or decreasing the depreciation and certain other factors. But manipulating the cash flows is very tough. Therefore, compare the profits with cash flows also. Three types of cash flows are there: cash flow from investing, cash flow from financing, then operating cash flow. So, after doing all these things, then you will decide whether to buy a company share. Again, see, the price is too high. If the price earning ratio is too high, maybe you will have to avoid that company even if all the fundamentals are good. Price earning ratio also needs to be taken into account. Generally, in the olden days, we used to say 10 price earning ratio, now 20. But many excellent companies growing very fast are having a price earning ratio of 50 or even 90. Still, good investors are buying. Because if price earning ratio remains the same and the company is growing at either the present rate of growth or a higher rate of growth, then price earning ratio can be put aside. You can go for it. So many such considerations are there to become a good investor and profit from that and become a crorepati. Nowadays we talk about billionaires. So let us hope you all and I will all become billionaires in course of time. Thank you for listening. I will come up before you with some of these principles also sometimes. And then our usual company analysis. That also will be there in December. Thank you for listening. You see, these are all matters which you should know. Don't go by tips of anybody, including me. You take them. I am giving you based on my analysis only. But you must go through my analysis and be satisfied with that or disagree with that. Then only you take your decision. It should be your decision, your profits, your capital, and long-term growth. Thank you for listening.